inefficiency and a misunderstanding of the mortgage markets that led to these institutions and individuals being invested in risky and volatile securities that were really worth far less than they were believed to be worth. And this time, an external factor made everything else like much more uncertain. So, yeah, I mean, just imagine this funding gap is like vastly increasing because nobody's buying the goods that you're selling. That's what's really causing a liquidity crunch, right? And that liquidity crunch will make it worse when you're taking on leverage, because now that funding gap becomes, more and more harder to fund. And yeah, obviously banks won't lend as easily, and it makes a really bad look for businesses who take on leverage. So, and
Yeah.
we never want to count that against them, but yeah, I mean that's gonna be there because people aren't buying as much stuff.
I
So yeah, go
mean,
ahead, Raghav.
when the debt to liquidity ratio looks bad, it creates a bad image for the business, as it doesn't look as investment worthy as before because it's more likely to go bankrupt.
Exactly. Yeah. So, there is a chance that the stimulus, it grazes at least fixing the credit cycle a little bit. That's what I guess the liquidity has to do with, to some degree. But we may see unnatural inflation after this money is actually, being spent. We might not see the effects immediately, for consumers. But it's quite obvious that stock prices are being artificially inflated. And a long-term consequence of this is that financial institutions across the world will not want to hold the United States dollar because they're concerned that the Fed will just print their way out of all sorts of debt. So, I mean, I guess we should take some time to explain why banks hold on to U.S. dollars so much. But basically, the U.S. has never, defaulted on any debt before. That might change. I'm not sure. But so banks consider, like all across the world, banks consider it very safe to hold on to U.S. dollars because U.S. dollar is it's an IOU from the government, and it's like it's a treasury bill, right? So it's always, I guess, fulfilled. The only way that it wouldn't be fulfilled is if the U.S. government were to default on its debt. So it is the most secure currency, and so I guess, I mean, if I were a bank, I would probably be concerned seeing that we're trying to print our way out of debt. And a long-term consequence of this would be that these financial institutions, they might be too scared now to hold on to dollars, and the dollars may not have as much of a buying power as it did before compared to other currencies. It might not see as much, I guess, confidence in it, right? So one way to measure this is the dollar strength index, the DXY. It's starting to show weakness when you put it up against other currencies, and it weights them by like how much the currency is flowing. So that's what the DXY is. It compares the U.S. dollar to the euro, the Swiss franc, and a bunch of other currencies, and the Swiss krona, I think. So yeah, this would put annuities like bonds at a major risk. If you understand the structuring of a bond, it's a fixed income security. So you can use an inflation index security that adjusts debt payment rates to inflation rates that are tracked by the Consumer Price Index, or CPI, and we'll have Mahesh talk about that more later. But these types of debt instruments were created so that in case the government starts printing too much to pay off debt, your bank account wouldn't be left worthless, right? Because I mean, at one point that currency, the promise, the IOU, which is a bond, it's not going to be worth anything if the government just prints its way out of it all the time. So and the Consumer Price Index, I guess I should talk a little bit more about that. Just an introduction to it is it tracks the prices of things. It's a basket of goods, right? And the increase in the price of goods is what causes inflation by the textbook definition. So an increased money supply can cause an increase in the price of goods. And I'll explain how that works. So now that people are making more money, there will be a higher quantity demanded, which forces a shift in the demand curve that adjusts supply curves as well. Right? And when supply curves and demand curves intersect, there can be equilibrium. But and so the Consumer Price Index itself, or CPI, it's compiled by the government as a basket of goods, and it takes their average costs in an urban environment to see how much an average person can afford. So the CPI doesn't just have essential goods; it has stuff like cigarettes too, which aren't an essential good. But it's just a weighted average of a vast variety of goods available. So yeah, and the last thing I just wanted to mention is we may not see this increase in money supply and income right now, but everything always trickles down from Wall Street to Main Street. So I just like people to remember that. You'll see inflation in stock prices, and We're seeing it in bigger assets that are more institutionally bent, I guess, like home prices. They're also inflating now. Um, so just watch out for inflation, and I guess hold on to as much material goods as you can to hedge. Like recently, we've seen silver and gold show some strength again. So yeah, I think that's my extent to what I know inflation to be, or to what I'm gonna discuss it in this episode. I'll pass inflation on now to Mahesh.